For decades, the Australian property dream was simple. One house, one family, one backyard. But as we move through 2026, that dream is split into two. High housing prices and a brutal rental market are forcing a record number of families to live together for longer. At Buyers Club, we call this the multi-generational pivot. We are seeing a massive surge in demand for properties that can accommodate parents, adult children, and even grandparents under the one roof. But this isn't just a social trend. For you, the investor, it's a gold mine. Today, I'm breaking down why dual occupancy properties are the best way to beat the higher cash rate that the RBA has blessed us in this year. I'm Roy, and this is Roy Talks Property. Let's look at the data. LJ Hooker recently identified multi-generational living as one of the top 6 trends for 2026. With the national median home price now sitting at $883,000, the financial barrier to entry for young Australians is at an all-time high. The result? Floor plans with second living areas, separate bedroom suites, or self-contained granny flats are becoming the most sought-after assets in the country. It's no longer about a nice-to-have studio. It's about survival and wealth preservation. For savvy investors, this means the pool of potential tenants and future buyers for those properties is expanding rapidly. You're not just renting a single household anymore, you're providing a solution to a national housing crisis. Now, let's talk numbers, the real reason you're here. A traditional 3-bedroom house in a middle ring suburb might give you a 3% net yield, which barely covers your costs in this environment. But a dual occupancy property, think a main residence with a detached studio or a side-by-side duplex, changes the math entirely. By having 2 income streams from one title, you significantly reduce your financial risk. If one tenant moves out, you still have 50% of your income flowing in. Furthermore, these dual income strategies are often the only way for investors to navigate the new APRA debt-to-income limits. Because the rental income is effectively doubled, your serviceability looks much stronger to a bank, allowing you to scale your portfolio faster than those stuck in the single tenant mindset. There's another layer to this gold mine strategy. In 2026, being EV ready is officially beating NBN ready, and it's being a valued driver for growth. As you build or renovate these dual occupancy sites, you must include solar, battery storage, and EV charging stations. Why? Because tenants are now paying a premium for homes that help them lower their cost of living. If you have 2 households on one block and they are both green powered, your rental resilience goes through the roof. Older properties without these features are increasingly being seen as dated or harder to rent. At Buyers Club, we advise our clients to bake these sustainability features into their dual occ builds from day one to future-proof their valuations. The 2026 market is only rewarding discipline and utility, and dual occupancy properties are the ultimate utility play. They solve the housing shortage for families and the yield shortage for you. If you want to see our internal list of suburbs where dual occupancy zoning is being fast-tracked, reach out to us at Buyers Club. We find the sites that the general public simply misses. And make sure you subscribe to my channel. We've got a lot more data to unpack. I'm Roy, and thanks for watching Roy Talks Property.